Good afternoon, everyone. Todd Robinson here. We're just waiting for everyone to join. So we're just going to hang tight for a minute and let everyone hop on, and then we'll get going on the webinar. So as everyone's joining, we'll have a little Q&A at the end. And so, feel free to put questions or questions in the chat here. I'll try to answer them as quickly as possible. And then we can go from there. We've got about 21, I think there's about 95 people signed up, which was amazing. So let's see if we can get a few more in here, and then we'll get going on the discussion. Let me open the chat here. Perfect. Very good. Again, welcome everybody. Todd Robinson here. We're just letting a few more minutes pass before we get going on the presentation and the webinar, letting people join. So give me a couple of minutes. We're just getting all of the participants in, and we've got the chat open. So if you have any questions or any comments, feel free to put it in the chat. And I'll be honest, this is my first time hosting something like this. I'm very excited about it. I'll explain really the basis behind doing something like this and the offering that we have for this program. But I'm usually the one speaking at these events and not having to man the technology at the same time. So if I seem a little flustered in the beginning, then that's the cause. So again, just waiting for everyone to jump on here. And you know what? I think it's been a couple of minutes. We'll probably go ahead and get started here. And again, as I mentioned, my name is Todd Robinson, and I'm presenting today to you the basics of real estate syndication, best practices and investment strategies. And this is an overview of key concepts in real estate syndication, one of my specialties as a real estate finance and investment lawyer, and also a real estate investor on my own. So here's a little bit about me. Who's given this presentation? I'm sure you're interested. So I'm the owner and managing partner of a law firm here in Atlanta, Georgia. It's called Robinson Franzman. It's a boutique corporate and commercial real estate law firm that I started in 2018 with $0 and a laptop in my basement, and have grown the firm to nearly $10 million in gross revenue through various partnerships, through networking. Also a serial entrepreneur. I've started several businesses and scaled several businesses. The domestic staffing company is kind of a funny story. I started that company in law school and actually used revenue from that company to pay off my law school student loans 3 years after I graduated. Also own a legal services staffing company worth about $1 million after we purchased it for $50,000, and a property management company managing over 150 properties. I'm also a real estate investor. I've also been a real estate investor for nearly a decade, the owner of Iron Street Capital. It's my real estate investing company that I use to invest in purchase and commercial real estate. And so here's just a list of a couple of the deals that I've been involved in. This doesn't include some of the single family stuff that I've purchased, some of the flips I've done, also using other people's money. So you see here 745 units I've been either involved in directly, or I've been involved in directly, and they've either been sold or they're projected to be sold soon. So the purchase value of these around 65 million, projected sale price close to $97 million. Just to give you a little background and hint into the value that I've been able to extract with my partners on some of these deals. So you probably noticed this icon here at the beginning, OPM Nation, Real Estate Investing Community. I wanted to provide this webinar as really a showcase of what we've created at OPM Nation. OPM Nation is a real estate investing platform and community. We're hosting the community on skool.com, SKOOL. And I'll explain a little bit more about the community when we get through the end of the presentation. But essentially, it is going to end up being a mastermind. And this is kind of our showcase of the types of webinars and presentations members of the community will get access to as a member of the real estate investing community and potentially an upgraded member of the mastermind that we've started. So we're talking about real estate syndication today. What is a real estate syndication? Well, at its very core, it's a partnership. It's a partnership between a sponsor and investors, okay? The sponsor puts in the sweat equity, puts in the work to find the property, to find the financing, to work with brokers, and puts in all of the sweat equity required to get the deal closed. The investors put in the capital. So it's a symbiotic relationship between sweat equity and actual equity, okay? And through that partnership, the property is purchased, money is made, and money is shared at the end via a capital transaction, capital event, or a refinance, which is also a capital event. But as you see here on the slide, it's a pooling of funds through a partnership. There's shared ownership. So limited partners who come and purchase a property through a real estate syndication as a limited partner, although they're limited in nature via voting and management, which we'll talk about in a minute, but they actually have a direct ownership stake in the real property itself. And so that provides a lot of comfort to investors that are looking to buy or getting into real estate. And that's one of the things that we're going to teach through our mastermind program is how to find limited partners, how to find investors, how to find properties and how to underwrite properties. That's going to be real estate investing 101, but then how to scale your real estate portfolio through syndications and finding your limited partners who are going to invest alongside of you. Now, the property is managed professionally by the sponsor. And we'll talk about vetting sponsors in just a minute. And there's a diversification of assets. So one of the benefits of real estate syndication is that investors can access larger, more lucrative properties than they may not be able to afford individually. Okay, and then that's another method to scale your investment real estate portfolio. One of the things I often teach to students is one of the best ways of getting into real estate is to invest as a limited partner. And that's because it gives you exposure to the deal. It gives you exposure to the process. You get invited to potentially get invited to calls, depending on what the sponsor does. You often get asset management reports quarterly. And so you're able to really run through the numbers and get just familiarity with the process. So I often will say to real estate investors who are interested in getting into syndication that they invest first passively as an LP, get the experience, and then move to the GP side where you can start finding deals and taking down deals yourself. So that's certainly one of the key tips that you'll learn through this program. So what are the benefits of real estate syndication? Well, there's a ton. There's a lot of risks too, which we'll talk about in a minute, but these are definitely the benefits. Syndication allows investors to pool their resources and to enable them to access higher value properties that they may not be able to afford individually. Now, here, I'm trying to change this. Okay, there. I thought that went to everyone, but it went to the host and panelists. Diversification. So an LP can invest in multiple syndications, right? It gives you a diversification of investment opportunities with various sponsors and various deals. Building credibility. It builds your credibility as a limited partner so that when you go and you find your first deal, you can now present to a possible lender, here's my track record. here is all the deals that I've invested in as an LP. And, you know, one of the best thing, and I actually posted something on this on my Instagram profile, but the best and the most attractive thing that investors and lenders want to see is a track record. Okay. Now, passive income, syndication, depending on the type of investment it is, provides investors with a steady stream of passive income through the property's rental and operational cash flows. And you don't have to actively manage it. We call this in the industry mailbox money, right? You get mailbox money through a syndication if the property allows for it. Now, it depends on the type of deal, whether it's value add, opportunistic, core. We'll talk about that in a minute. But mailbox money is one of the greatest benefits of a syndication. What that means is you typically will get a quarterly return, or if you're a sponsor, a GP looking to get into syndication, you will give a quarterly return to your investors based on, you know, the financial model that we come up with for the particular deal. But a hypothetical would be, you know, $100,000 investor, and you're giving them an 8% preferred return. So what does that mean? That means on the $100,000 that you provide to them, they're getting $8,000 a year. That's $2,000 a quarter. That money has to come from the operations of the property, and you have to make sure that you model that out financially through your financial model and your pro forma to make sure the property can perform at that level. But when you're pitching deals to potential investors, this is the biggest hook for investors to come and invest with you, which is mailbox money. Hey, you want a check to show up in your mailbox every quarter for $2,000? Absolutely. Most investors will jump at the chance of that. Professional management. That provides comfort to the LPs that these deals are managed by experienced sponsors. Now, we'll talk about what an experienced sponsor is. There's been a lot of news lately, especially at the end of last year, with deals that have, you know, gone sideways, with inexperienced sponsors that have gotten out over their skis, so to speak. So professional management is going to be really important. And of course, tax advantages. Limited partners get exposure to bonus depreciation. Okay, it's a tax strategy that allows certain types of investors to offset passive income or ordinary income with passive losses. Now, losses occur in a syndication when the sponsor performs what's called a cost segregation study. And we can talk more about that. We'll talk more about that in our mastermind, about how to do a cost seg, what vendors I would use in a cost seg study. So that's going to be very important. Another big benefit for your investors. So is it a security? You know, this is the biggest question you need to ask yourself. Do we need to comply with securities regulations? And a syndication is an exempt offering under the Securities and Exchange Act, okay, which is a federal law that came about in the 1930s to protect investors. It came from the Great Depression. It came from all of the, you know, greedy families that were taking advantage of investors back in those times. And so the Securities and Exchange Commission came up with this potential, this definition to make sure they protect the investors. That's really what the SEC is for. So there was one particular case, the Howey case from 1946, that came up with the elements of what a security is. So you have to have an investment of money, right, in a common enterprise, right? That's the symbiotic relationship between the investors and the sponsor, which is to purchase real estate. The investor expects a share of the profits. That's huge, okay? This isn't a debt instrument, right? This isn't a loan where the investors are loaning money to the sponsor and they're just going to get their money back plus their interest rate and that's it. No, the investors are getting a share of the profits when there's a capital event. But the key also is that those profits are solely from the efforts of the sponsor, okay? That's huge. The sponsor is putting in the work to manage the property, to manage the asset, to manage the cash flow, to manage the lender, you know, respond to tenant complaints, work on maintenance issues, implement capital improvement projects. All of that is the sponsor's responsibilities. So for those looking to get into real estate, looking to start a syndication, that is your job, putting in the sweat equity. And the investor who's putting in the money is not participating in those activities. They have no voting or management responsibilities during the day-to-day operations. And so that's the symbiotic relationship. But the SEC and frankly, the Supreme Court has said if that occurs, then it is a security and we need to protect those investors. So here's a decision tree. I brought this from another slide of mine, excuse me, another presentation that I've done. I thought it's a really good kind of decision tree of is it a security or not? And if it's member managed, it's not a security. Now, I have a whole separate webinar and presentation on what's the difference between joint ventures and syndications. That's something that's actually in our real estate investing community on School. That whole presentation is there so that you understand the difference between a joint venture and a security. One of the differences, I'm sorry, joint venture and a syndication. One of the differences is it member managed, right? Is it managed by all the members together? Okay, now joint ventures have a lot of other complexity, which we can talk about in our mastermind on the School platform, but just know that if it's a member managed transaction or member managed company, you're not really in the securities world. Okay, so we don't have to worry about SEC regulations. If it's manager managed, now one of the members could be a manager, right? But if that distinction is made in the operating agreement, or perhaps it's an outside manager, what we call a non-member manager, which I'll show you in the next slide how that works, then we do need to worry about SEC regulations, okay? Now, there's two types of SEC offerings, regulations rather. One is Regulation D, which is the world that we're in. These are exempt offerings from the SEC registration process. The other is public offerings, either large or small. Reg A offerings, crowdfunding. I was talking to a client this morning about a Reg CF crowdfunding regulation. That is, when you hear that, think about Uber, think about Tesla, think about these companies that are going public, right? That offering to purchase that security in that company is fully vetted through the SEC. It's fully vetted and baked and analyzed by investment bankers and by the SEC itself. The SEC blesses it. Then the shares are created and sold on the public market. This is not what we're talking about. We are talking about a private offering, meaning it's either offered to friends and family or it's offered to the public, but on a private platform, not through the stock exchange. So there's two offerings here that you need to be aware of. One's called a 506B offering. One is called a 506C offering. Now, these are references to the regulation in the Securities Act. A 506B offering, we call that your friends and family exemption. Most everyone who starts out in syndication starts in a 506B because they have a group of friends, or they're a part of a mastermind like mine, or they're a part of a network where they are going to tap into in order to raise capital. Now, you are only allowed to have 35 sophisticated investors in a 506B, okay? That means you're not accredited, okay? And that means that you are sophisticated, but you're not accredited. And you're allowed to have an unlimited amount of accredited investors, but you're not allowed to advertise, okay? That means you can only mention the offering to your friends and your family. And I saw Peter has raised his hand. Peter, you want to stay? If you have a question, go ahead and stick it in the chat. Hopefully the chat is working. And I can, you can send it to me or you can send it to everyone, and I'll be happy to just answer that live. So all good. I'm not, again, I'm very technologically challenged, so I'm not sure how to respond to the hand raising, but put it in the chat and let me, Andrew's got one too. Put it in the chat and then I will just answer it live, guys. So Reg D, we're calling that friends and family. Let's see, is the chat working? Can everyone see that? Hopefully. Max, 35 investors, no advertising. So that's the big key. You can't go out and put this on Instagram. You can't go out and put this on Facebook. You can't go do a webinar like this with people that you don't know. So for instance, if I was doing an offering right now on a deal that potentially I was going after, I wouldn't be able, I know some of you, some of my current clients are actually on this webinar, and current colleagues that I know are here. And so I would be able to offer this offering to them, but to the ones that I don't know, I would not be able to make that offering to them. So unlimited accredited investors, 35 sophisticated investors, no advertising, no solicitation. You need to have a pre-existing substantive relationship. Oh, chat's disabled. Okay, gosh, how do I do that? Okay, well, put it in now. Put it in the Q&A then. And I apologize, guys. The chat is disabled. I'm not sure how to enable it, but put it I can see your question. So if you want to put it in the Q&A, I apologize. I don't know how to. Oh wait, here we go. Let's see. Everyone. Okay. Let's see if that. I think. Got it. Awesome. All right. There we go. All right. So again, first timer here. First time managing the board. I'm usually the speaker, not the not the board runner. So glad we got that figured out. Okay. So 506B, and again, if you have questions, go ahead and pop it in there, and I'll try to answer them live. The difference between B and C, the big difference is 506C, you only can have accredited investors, right? Now, if you're a high net worth individual or you run in circles with accredited investors, we'll talk about that in just a minute, then you could do a 506C. You're allowed to advertise. That's the big rub. And so these exemptions came about from the Jobs Act in 2012, where the private equity community basically said to Congress, look, the internet's a big thing. Social media is a big thing. We want to be able to advertise our offerings. How can we do that? And so that is when the difference between 506B and 506C came about. And 506C allows you to advertise, but the rub, you cannot accept any unaccredited investors. And I'll describe what an accredited investor is very shortly. And you don't need a pre-existing relationship. So if I had a 506C offering right now on one of my deals that I'm working on, I can present it to you guys. We would go through the Q&A, and actually how to present a deal in a webinar format is something that I'll teach you, and how to make sure that you have those hooks so that in your elevator pitch, when you present an offering to somebody, that your investors are going to be eating out of the palm of your hands. So that's the big difference. 506B, 506C, you need to understand that. And the first question I'll ask if we're doing a raise or if we're handling the legal documents through my law firm is, are you going to advertise this or not? And if the answer is yes, we're going to do a C. If it's not, we'll do a B. Now, you can go from a B to a C, okay? That, again, something else we'll handle in our real estate mastermind. It requires some loopholes to jump through, but you can certainly do it. Like we have a deal right now, a self-storage deal in Florida we're working on where, we did a 506B to start, and they didn't raise enough capital. So we had to bump it to a C, and so now they can go ahead and advertise. So Peter, good question. For a 506B marketing limitations, can you include information on a website? Yeah, you can do that because you're not soliciting. You're not soliciting investments. Now, if you put it on your website and you said, contact me for more information, and it's a 506B and you don't know who may see that and contact you, I wouldn't recommend doing that. But to just put your deals on your website as, either deals you're currently working on, and there's not really an opportunity for people to ask about it. You just want to kind of showcase your experience. Yeah, absolutely. That's fine. So here's, another slide here, security exemptions for syndications, 506B, 506C. We're talking about 35 sophisticated but unaccredited investors, no advertising, unlimited amount of accredited investors. 506C, only accredited investors, and you can have no sophisticated investors. I know the terminology even gets confusing in my head, but really the question comes down to, do you want to advertise or not, is number one, and who is in your investor network? Is it, do you have friends and family who are very wealthy? You maybe can get away with doing a C, or do you, one thing I forgot to mention, here, down here, so accredited investors may self-certify in a 506B. What does that mean? Part of our package that we put together in our through the firm is an investor questionnaire. Now, the investor questionnaire basically asks the investor, your LP, are you accredited or not? And I'll have a slide on accreditation. We'll go through that in just a minute. And in a B, you as the issuer, the sponsor, have discharged your duty with regard to determining whether or not they are accredited. Okay. In a C, you have to take it a step further. You have to require accreditation proof. Now, there are third-party companies that do that. If you have an investor platform like AppFolio, Syndication Pro, Cash Flow Portal, things like that, you can if your deals are on that platform, they have an accreditation service. I will often do accreditation for my clients. Attorneys can do it. CPAs can do it. So that's a big difference. A lot of people don't want to ask those questions because it's a little invasive. I mean, you're going to say, hey, show me your bank statement, right? Show me your brokerage account statement that shows your net worth and your liquidity, how much money you have. I mean, a lot of people don't want to ask those kind of personal questions directly. You'll have someone else do it. So that's a big difference between the B and the C as well. So here you go. What is an accredited investor? So your accredited investor, this definition was, they looked at changing it, but they haven't yet. It was kind of kicked around Congress. They haven't changed it yet as far as I know. But it's a net worth of $1 million or more, excluding your primary residence, okay? Or annual income of $200,000 as an individual, or $300,000 if you're married and you're filing jointly. If you meet one of those requirements, you're an accredited investor. So in my mastermind, in my investing community, we are going to have tags where people will know if the other person that they're going to talk to is an accredited investor or not. And so we'll be able to raise capital within this community from accredited investors and non-accredited investors. But this is the kind of information that you'll have to verify if you're doing a 506C. Now, a lot of times I'll get questions about entities that are accredited or not. Now, you have to have a net worth of at least $5 million in the entity, but it cannot be formed for the purpose of investing in the real estate. So that happens all the time. I'll get 5 or 6 guys that'll get together and they'll put an LLC together and they'll say, okay, we're accredited. Here's our accreditation. But if you formed it just to invest in the real property, then it's not going to count as an accredited investor. Now, what's a sophisticated investor? That's really everyone else. If you don't meet the accredited standards, you're sophisticated. Now, you typically need some level of sophistication and or knowledge of finance or investments in real estate in order to be a sophisticated investor. I've never seen the SEC enforce something like this. I always, when I give these presentations live at multifamily investment events, I always will give the example of, you have a teacher next door to you who's your neighbor who inherited, $5 million from her aunt. But she's a teacher, right? She goes and teaches school kids every day. But she's got a lot of money. Is she a sophisticated but non-accredited investor? I would argue no. But can she become one? Yes. Can you help her learn some basics about real estate and finance and investments and get to a comfort level where she has some knowledge? I mean, the gist is the SEC doesn't want you taking advantage of, the little guy who may have a lot of money but may not know anything. So there is some level of sophistication required, but again, it's not something that I've seen enforced by the SEC. All right, here we are, the friends and family exemption. So you have to have a pre-existing substantive relationship with your investors. And again, we're going to define this. We're going to drill down on your relationships. For those that actually sign up for the mastermind, we have a very deep one-on-one 2 or 3 hour call for the coaching program where we're going to get into your network and you're going to identify investors that you didn't even think you knew you had when we get through that program. But the relationship must exist prior to the commencement of the offering. That's very important. You can't have an offering and then you go out and meet an investor who becomes your best friend, but they weren't your best friend prior to the offering, okay? No set minimum amount of time that must exist prior to be pre-existing. Again, the SEC is not going to give us the rules. They want to keep it gray on purpose because they need to keep their enforcement jobs, frankly. But we have read the tea leaves. We have, read there's federal cases on this type of issue. We've seen the no action letters by the SEC. So this is my best advice when it comes to what is a pre-existing relationship. There's no set time, but there must be a sufficient amount of time between establishing the relationship and the offering. So it's not considered solicitation. That's what we're trying to guard against, right? Because you can only solicit in a 506C. So it's not considered general advertising or solicitation. So there must be sufficient time. So what does that mean? Again, this last one, substantive relationship, is one. This actually comes, I believe, directly from a case. To determine whether someone is in your network to be considered pre-existing. So what I like to what I teach to my students is you got to have a 3-touch rule. Okay. So what does that mean? That means you've contacted them personally at least 3 times. And for those that join our mastermind and our real estate investing community, we're going to track that. We're going to track your investors. We're going to track who you're reaching out to, and I'm going to coach you through that so that we can get to the point where, okay, this person is in my network. They are in my accredited, in my friends and family network, and you can reach out to them once we have a deal that we're going to run. Got it. Okay, so this is our sample syndication org chart. This is from our legal perspective. This is from my firm. We created this whenever we do a syndication. We do the legal documents. This is a sample org chart that we use and we give to our clients. And there's a couple important things to note. And again, this is deal by deal and something that we will discuss and when we're actually working on actual transactions. But the Apple Creek investment property, the property is owned by what's called a single member entity. That's not always required. It depends on the lender, depends on the size, depends on the type of deal, the type of financing. But the syndication really occurs in Apple Creek investments. There's a question about the slides. Yeah, I'll be able to send out those slides to everyone who's joined for sure. So Apple Creek Investments is the syndicated entity. We have our Apple Creek manager. This is our Class B, our management level entity. And then we have Class A and Class B. Now, we made this change a little while ago where we used to have the Class B member be the manager. But for tax reasons, we've split the promote that you'll get when we structure deals and the fees. One thing, again, I didn't put everything into this webinar because a lot of it is going to be in for those students that join the mastermind. But if a typical deal is structured, let's say 70% to investors, 30% to the GP, that's the promote. So when you sell the property, if there's $1 million of profit, $700,000 goes to your investors, and it's split pro rata amongst based on their membership interest. That would go to the Class A members. 30%, in this instance, $300,000, is going to go to your Class B member. Okay, your Class B member has to be an affiliate, but we separated out the fees and the promote for tax purposes. So fees get treated as ordinary income at a higher tax rate, and your promote gets treated as capital gains at a lower tax rate because it's usually going to be higher. So your fees in this instance will go to Apple Creek Manager. And then you see here, we've got GP Entity 1, GP Entity 2. This is very important. A lot of first timers and a lot of people who are trying to scale their real estate portfolio, they're not going to take down a deal by themselves. And this is one of the reasons why we created this investment community, was that we can take down deals together and solve each other's roadblocks together. So this particular org chart contemplates partnering with another GP. Now, GP entity number 1 may have a ton of capital connections, and he's getting his interest because he's able to tap into that network and provide the equity that we need to close a deal. GP entity two may have, no capital connections, but is really good at asset management, really good at property management, and really, pushing those rents and responding to tenants. That's a great relationship that we'll be able to put together to take down larger transactions. So, so that's the point of having two particular GP entities in this particular slide. So Class A and Class B, again, that's down here. I guess you can't see my pen, but I'm a big hand and pen guy. But Class A, Class B member. The Class B members are the sponsors. Now, again, within our mastermind, I have a whole presentation on the nuts and bolts of the operating agreement, the syndicated operating agreement, and who does what, and whose rights, where the rights are and the management responsibilities. Class B members are the sponsors. They have actual voting rights. They have fiduciary management responsibilities. They own a percentage of the equity. Typically, it's the promote percentage, so it's 30%. Equity splits can increase based on performance of property returns. This is a little more advanced, and again, something we would cover on a one-on-one mastermind, but you can create waterfalls based on property performance. So if you're selling at a higher cap rate, lower cap rate, but higher purchase price than you thought you would get, you're going to provide better returns for your LPs, which means you should get better returns as the GP. So we can align the incentives between the LP and the GP so that the GP is getting a larger share of the equity at closing. Class A members, these are the investors, right? Remember, we talked about the symbiotic relationship between the sponsor and the investors. No voting rights, no management duties and responsibilities. They own typically a larger share, and they offer a preferential return on top of their equity. Remember, I talked about that $8,000 on a preferred return on a $100,000 investment. That's considered a preferred return. Now, it's preferred in terms of payment priority. Really, it's not preferred in terms of collateral or security that they have. It's just in terms of payment and performance. Okay, so Justin, there it came back. Sound was a problem. Okay, good. Let me know. Yeah, y'all keep me posted if you have any issues that arise. Looks like the sound came back. Okay. What are we at now? And then again, any questions, just pop them in there. I'm happy to answer. The PPM. So again, part of our syndication package, you're going to provide, especially if we do the legal work, either if you use another lawyer for the syndication work, that's fine. But even as your coach, I'm going to make sure you have a PPM and I swear I'm going to coin this term, PPM CYA, cover your ass, right? Because this is your disclosure document that is going to cover you in the event that something goes wrong that you could have anticipated or that you have disclosed to your investors. This is the bulk of the legal work in a syndication. It stands for Private Placement Memorandum, and it basically is an all-encompassing, usually 60, 70-page document that has everything under the sun that you need to give your investors. Now, the investors don't sign this document. They are just provided this document. And it's important that you provide it because the biggest issue is, liquidity, dispute resolution, risks. Sorry, I was looking for risks. Risks are huge. If you're taking down a value add property, for instance, and let's say there's a completely burned down building, but it's a huge value add opportunity. You're going to have a huge construction budget. You're going to have a huge interest reserve, and the execution of that business plan is going to hinder on, construction prices. Well, what if construction prices go through the roof? What if you got this deal right at the beginning of the pandemic and construction prices just went through the roof because of supply chain problems? In a PPM, that risk is going to be disclosed. So if you're not able to provide returns, or God forbid you get foreclosed on, the risks are going to be present there for your investors. So that is the biggest section of the document that we really go through to understand, because we have to understand that the business plan of the sponsors so that we can disclose the risks appropriately. This is also the biggest document that the SEC will focus on if there was ever, God forbid, an enforcement action or an inquiry into a syndication. They want to make sure that the PPM terms match your offering documents. Sorry, not your offering documents, your pitch deck. And again, through our mastermind, we're gonna drill down on how to create a pitch deck, what you should include in a pitch deck, the disclosures that are required in a pitch deck, how to underwrite deals, how to present that underwriting to investors. But if you're promising, an 8% preferred return in your pitch deck, and all of a sudden the PPM says a 5% because you want to take 3 for yourself, that's a huge problem, right? So those have to match completely, because we don't want to be accused of misrepresenting any terms in the private placement memorandum. Real quick, description of the business, offering terms. Now, the actual terms of the operating agreement on the investors' cash and their cash positions and what they're going to get, that's going to be also disclosed in the PPM. Conflicts of interest. One thing I didn't put on these slides, and this is very important for those interested in becoming sponsors and becoming GPs, you get paid typically at the beginning and at the end. Now, at the beginning, you'll get paid an acquisition fee, right? Usually 1 to 2% of the total project cost. And that is your compensation for, it may take you 3 to 5 months to put a deal together, and you should rightly get paid for that. And your investors will pay that acquisition fee. But it could be considered a conflict of interest, right? I mean, are you closing this deal because you're going to get a fee, or are you closing it because it's in the best interest of your limited partners that are coming along with you? So those kinds of risks and disclosures are going to be noted in the private placement memorandum. Sources and uses, another big one, and this is something we will drill down on together. What are your sources? What are your uses, right? Your sources typically is a loan and your equity. Now, if we're doing a creative financing type of structure and we're using 100% of other people's money, which we'll teach how to do that in our program, that's also going to be listed in the sources. The uses, obviously acquiring the property, it just really depends deal by deal, but acquiring the property, interest reserve, CapEx reserve, paying the fees, that kind of thing. But those have to align before we can actually close a deal. Distribution and fees, we just talked about your acquisition fee. Some sponsors may also charge, they may charge a disposition fee. I've seen that, I've worked with that. A refinance fee, a guarantee fee. Some of these can be a little rich. Again, it just depends on your investor database, your network, what their tolerance is for these types of fees. Acquisition fees larger than 2% are typically frowned upon in my experience. But you'll also get paid an asset management fee. So, which is not much, it's not a lot of money, but it's the fee that compensates the sponsor for managing the investors, managing the property manager, right? You're the one answering the questions by the property manager. You're the one responding to investors, creating your quarterly reports, which we'll talk about in our program. So that it's a small fee. It's usually 1% of the rent, and so you kind of tack it on to your property management fee in your pro forma model. But again, that's some compensation that will come during the term of the deal. Voting rights, we talked about. Property management, liquidity, dispute resolution. How are disputes resolved? One of the terms in my operating agreements that we prepare through the firm is the removal of the manager, which, if we go back, the removal of this Apple Creek manager in this particular example. As a sponsor, we want that as tight as possible. And I've drafted language that says, the Apple Creek manager may only be removed upon an adjudication by a court of competent jurisdiction. That is the highest level of scrutiny to remove a manager. And that's our standard language, because we obviously want to put, if our client is a sponsor, we want our sponsor to be in the best position. And when we're doing deals, that's how we're going to put the language. But I've had investors really push back on that, and they've said, well, wait a minute, what if we think the manager's doing a bad job? How do we handle that? So we can change that and say, 75% vote of the LPs. I mean, it kind of just all depends, but that's the other dispute resolution piece here. The syndication process. This is pretty self-explanatory, but again, something that we'll talk about in the mastermind. So identifying the property, obviously, raising the capital, engaging with investors, developing your elevator pitch, high net worth individual, institutional investors, I think is a step above. If you're at that level and you've got 100 units or more under your belt and you want to get into the institutional level type game, I can help you with that through our mastermind or our coaching program, because I've got connections all over the place and can connect you with the right institutional investors and the equity brokers that I know up in New York. But you have to position yourself as someone that these institutional investors want to invest with in a programmatic type fashion. That's what all of them are looking for. And so we can create that program that puts you in the best light. Acquiring the property, executing the purchase, obviously, of the property, working through lenders, and through our law firm, we handle transactions really soup to nuts. We start at the LOI phase all the way through closing. We handle the purchase and sale documents. We handle the capital raising, obviously, through the syndication. We work with the lenders to get the financing paperwork done. And then I own a title company as well. And so we have a national title company that we will handle the title and escrow for all of the deals. So it's a one-stop shop for sponsors who are acquiring property, and then managing the asset. That's the biggest thing. Acquiring it is one piece, but do you have the skill set to manage the property and push those rents, and defining your business plan? One of the things we're going to go through in our mastermind is, how do you define your business plan? What is your buy box? Do you stick to your buy box, and have you really vetted that buy box? Sponsor qualifications. Now, these are for LPs and obviously for sponsors as well that are listening that want to get into deals. This is what people are going to be asking of you, right? And this is what you need to show them. And LPs that are interested in investing with sponsors, this is what you need to be asking. You need to be asking those sponsors that you're interested in. What is their experience? Do they have strong investor relationships, their financial stability and resources? What is their track record? Again, most first-time investors who are getting started, they may not have a track record. They're going to rely on their friends and family. They're going to rely on their best friend from college and their, college roommate and maybe some colleagues at work that just kind of know them and say, okay, here's 50,000, here's 100,000, let's go buy something. Are they transparent and ethical? Obviously, that's a huge deal. Commitment, transparency, integrity. I cannot tell you how many transactions and deals I've been in where the sponsor misrepresents or is not transparent or puts off talking to his investors. I mean, the lack of communication is the biggest killer when it comes to misrepresenting, or when it comes to having a disgruntled investor call the SEC. So that's very important. Vetting the sponsor. So these are just typical numbers, nothing really set in stone, but what's their experience level, number of deals they've done, average annual return. This is also huge. What is your average annual return that you've provided to your investors? Now, if you're a first timer, you may not have one, but as soon as you get that first deal under your belt, and again, people who join our mastermind program will get their first deal under their belt in 90 days. They are going to ask you what those return structures are. So being able to sell that property, make a return, put it on your personal pitch deck is key. Average occupancy, that's an interesting, that really kind of depends on the type of deal that it is. But obviously a sponsor being able to push occupancy is going to be really huge. Alternative investment structures, I'm just curious, or not curious, I'm just mindful of the time. So we've got about 10 minutes left. There are different types of investment structures. Obviously, there's equity and there's debt. We typically, investors providing loans to the sponsor, I typically frown upon, because that is going to usually violate your loan documents. Your lender is not really going to allow subordinate financing. Most lenders are comfortable with equity structures, so just be mindful of that when you're trying to raise capital. Investment strategies, so value add approach, opportunistic approach, core plus, and income focused approach. There's a lot of people on this call. I know some of my colleagues and clients, are very familiar with all of these types of approaches. But if you're just getting into real estate, you're going to want to know these terms. You're going to want to understand what a value add deal is, right? What's an opportunistic transaction? What's a core plus? Core plus is like, really prime location. Usually the returns are lower in a core plus because there's not as much upside. Income focused approach. Is it a long-term strategy? A lot of pension funds, life insurance investors, they look for long-term income producing assets. So be familiar with these different approaches. Okay, a couple of slides left here, and then we'll finish up. We'll have a couple minutes left for questions. You can put them in the chat here. We can run through them. This is not meant to scare anybody, but I came across this slide on another presentation, and it's sort of real world examples of securities violations. If you Google any of these sponsors, you'll see the kind of stuff they were doing. But Matthew Skinner, this is a 2021 case. What is that, 3 years ago? But these are outright blatant violations that anyone who's involved in my program or that I represent or work with as a coach or a lawyer I'm not going to work with them if I find them doing this. So this guy was lying about projections, using funds. He was using funds in his fees from other deals, and he was directing it to other transactions and other bank accounts. So obviously that's a Ponzi scheme, and his investors reported it to the SEC, and he was charged and had they seek disgorgement, prejudgment interest, civil penalties. It's a real mess. Here's another one from 2011. Father and son in Utah were charged with securities for selling purported investments in the real estate business. Turned out to be a Ponzi scheme. Again, lying to investors. Sources and uses that we talked about in our PPM disclosure. If you're not abiding by that and you're just misrepresenting investors, I mean, it's a pretty shut and dry case. And then here's the last one, 2017. Again, same type of issue. There's an unregistered offering for the sale. They considered him more of a broker dealer, and he violated broker dealer regulations. And again, we can dive deeper into the different exemptions. If people want to get into funds, we obviously do a lot of fund work. I can coach on fund work and work on funds as a legal consultant. So this is a little bit different, but just to give you an idea, the hammer can be dropped if things go awry. So just be wary when you're getting into real estate and you're specifically looking at scaling your real estate portfolio using syndications. It's very important you have a trusted mentor and coach to help you through that, and a trusted firm that knows how to do it. So that leads me kind of to my last two slides here. Let me ask this question real quick that Rachel mentioned. For LPs, do they have to invest their retirement funds, or can they do it through a regular bank account? Bonus, they got their bank account from their employer. Absolutely, Rachel. So here's the deal. Your LPs can invest however they want. It's their cash. They can invest it through their retirement fund. If they may have a savings account, they may have a savings account somewhere with a couple $100,000 in it, and they want to send you 100 of it. It doesn't really matter. It just needs to come from them. But here's the catch with self-directed IRAs. Self-directed IRAs are not entitled to bonus depreciation. Okay, that's very important. Self-directed IRAs are not entitled to bonus depreciation because they're already getting the tax benefit of that money growing tax-free within the retirement program. So the government said, well, if you're already getting that tax benefit, we're not going to give you another tax benefit by investing in this real estate and double dipping. So if you have investors that want to invest through a self-directed IRA, you just got to be clear with them. They're not entitled to bonus depreciation. So last two slides here, guys. OPM Nation, look, I've created this real estate investing community really as a response to clients and my audience and colleagues that, are interested in learning more about scaling their real estate portfolio, or they're learning about getting into real estate to begin with, and they want to learn from someone that has actually done it, developed a $100 million portfolio, and has the legal knowledge to guide them through this process. So I've got two options for you. The community that we've created, it's typically $97 per month, and it's through the School platform. I don't know if you've heard of School. It's SKOOL. It's where a lot of communities are. And in that platform is where we're going to have all of our investors are going to be in that platform. We're going to, solve each other's problems. That's where all the classroom modules that I've mentioned are there. And you're going to be able to grow your investor network. And this is something that is unique to this particular community. And if it's not a fit for you, then I understand. But I'm trying to weed out those individuals that this may not be a good fit for. And so the catch is that every member of this mastermind community has to make a pledge to invest in someone else's deal. Okay. Now, you may not have money to invest in someone else's deal, but I'm not really worried about that. I'm worried about the mindset. I want to make sure that you have an abundance mindset, because the way this world works, the more you give, the more you shall receive. So this option, this invitation is actually free. It's typically $97 a month, but for those that joined and watched this webinar all the way to the end, you're going to get a link in your inbox to join this investing community for free. And we're going to have weekly Q&A calls with myself, and I'm going to help guide you through your real estate journey. And I promise we are going to scale your real estate portfolio. The last slide here is the actual mastermind, which is a step up from the community. Okay. And this is $14.97 for 3 months of direct one-on-one coaching from myself. So we'll have a personal one-on-one onboarding call. That'll really break down you and your journey and where you want to get to, help kind of set that vision. We're going to have weekly mastermind calls. It's going to be different than the Q&A. It's going to be very targeted, on the spot calls with what people are doing with deals actually in real time. You'll also get access to the community. You won't have to pay another $97, but you get access to the community as well. And then you'll get invitation to monthly real estate seminars just like this. So I really wanted to give this seminar to showcase what we're going to be doing on a monthly basis. Now, that's only for coaching and mastermind students. And then here's the other one. You get access to discounted legal fees. So if you're a mastermind student and we get a deal under contract, and if we funnel that transaction into the firm, which is not a requirement, but if you do, and we're going to do the securities work on it, you're going to get a $2,500 discount on those legal fees. And you are going to also access the other investors within the mastermind school community. My goal for this community really is we're going to develop the next generation of real estate investors. And it's just going to be an amazing platform guided by myself and my colleagues that we are going to grow everyone's portfolio either from 0 to over 1,000 or even above. So I really appreciate everyone listening and watching. This is the first time I've done something like this, but I think I hope I presented in a way that makes sense, that describes what we do and the value that I offer to everyone who plans on joining the community. There's a couple of questions here. One other question from Darren. It says, for the sophisticated investor, categorization is the required specialized knowledge or experience in addition to the monetary requirements of an accredited investor, or can someone be considered sophisticated without being accredited, purely based on knowledge? Yes. So the accreditation, really, remember, the accreditation is really just a dollar figure, right? I mean, someone can be accredited and be really wealthy. They say they made all their money, as a marketing executive at Coke, but they know nothing about real estate. They're still accredited because they have the dollar, but the law really presumes that if you have that level of net worth and you have that level of either $1 million net worth or you're making that kind of money, you're just presumed to be sophisticated and have that knowledge. So the sophisticated investor doesn't really require knowledge, meaning you can be anyone who's not accredited is sophisticated. So I hope that answers the question, Darren. if you have any specific questions about that, feel free to give me a shout. Here's my information, guys. This is my cell phone. Call me on that anytime. Here is my mastermind coaching program contact. And obviously follow me on Instagram, LinkedIn, and then here's the law firm contact as well with my law firm email. And so that's it. So if there's any other questions, feel free to pop them in the chat. PowerPoint, yep, I've got everyone's email address. I will email you the PowerPoint, assuming you sign up for the investing community, I should say. And you'll get an email in your inbox for the free invite. And again, it's free. Everyone else who wants to join is going to have to pay the $97 a month. But for all of you who stayed and watched it to the end, you're going to get it free. So that's it, guys. Thank you so much for watching, and feel free to reach out, and we'll be putting on another one of these next month. Thanks so much.